Today we'll start with the first chapter in derivatives called as what? Options. Okay. We'll now complete today the basics in option and try to complete as much as problem in the basics in the options. And next class onwards we'll start discussing the advanced issues. Okay. Now. Okay. Now, please. In the first class of the session, we said that in final we mainly deal with the markets. We deal with what? Markets. Understanding different markets and their valuations only is the main agenda for our final syllabus. We discuss about, to some extent, the currency markets in the chapter called as International Financial Management. We discuss about the fixed income securities in the chapter called as Bond Evaluation. Equity we elaborately discussed in the chapter Dividend Policy, the chapter Portfolio Management. We will discuss equity valuation more in the chapter that is the equity valuation itself. Merger also is mostly about what? Equity only. So equity has been dealt with very elaborately, right or not? In its company project selection comes as capital budgeting, a one-off area. Okay. Otherwise, mostly we're discussing about what? Markets. Okay. Now, in markets, one of the important segment in a stock exchange is the derivative segment. Okay. How we have stock exchange segment for shares. Okay, I want to buy TCS shares. I can go to NSE, buy and sell TCS shares. Yes or no? I want to buy Infosys shares. I can go to what? National Stock Exchange or Bombay Stock Exchange. Buy and sell what? Infosys shares. So for shares, there's a market or not? Where you buy and sell share? The stock exchange. Okay. Now, in the stock exchange, we can buy and sell TCS shares. We can buy and sell what? Infosys shares. We can buy and sell Axis Bank. Like that, any company, MTG can share. So many shares. Companies are listed and the shares are bought and sold. Right or not? Either we call us what? Share market. We call us what market? Share market. If you want to buy dollar, what I can do? Go to a bank. Go to an authorized dealer. Buy and sell what? Dollars. And I can go to an authorized bank, buy and sell what? Pounds, euros. So currency is having a market. There we deal in what? The banks and authorized dealers is going to deal in the currency market. Response is on no. I want to buy a Government of India bond. Can I buy or not? Yes. Once again go to what? National Stock Exchange or Bombay Stock Exchange. There's a bond segment. There is what? Bill segment or T-bill segment. I can go there and what? Buy and sell Government of India bond. Buy and sell what? Corporate bond, Reliance perpetual bond. Like that. So many bonds are being traded in what? Stock exchange. There's a market for bond. Yes or no? Like that, we have a separate market for what? The derivative instruments. Market for what? Derivative instruments. And that market can be stock exchange, can be outside stock exchange also. Are you following what I'm saying? Now, about those only, we're going to discuss in our session called as derivatives. Okay. Now, I have to tell what is derivative. This is a customary discussion. I have to tell what is derivative. Even if I tell, you won't be able to properly appreciate it unless you experience the contracts or instruments live. Okay. But it is my duty to introduce to what is derivative or not. Okay. Derivatives are nothing but contracts. Are nothing but what? Contracts. A derivative is what? A contract. That contract on its own does not have a value. Does not have what? Value. The contract gains value from the underlying asset on which the contract is made. Are you following what I am saying? So what is derivative? A derivative is what? A contract. It is basically a contract between two parties and that contract has a own value. The value of the contract depends on what? The value of the underlying asset. We call as what? On some asset contract should be paid. Yes or no? Contract should be made on something or not. On what contract is made, that becomes what? Underlying asset. On the basis of the underlying asset value, this derivative contract is what? Value. That is what we call as derivative instrument. Everybody put it. With this, what you understood? We can say it is a contract where it gains value from what? Underlying asset. You will understand the significance of this sentence after 1 month. Everything we will be discussing only what? We are only with this particular background. So it is a contract whose value is obtained through what? Value of the underlying asset. On its own, it does not have what? Any value. Any instrument which derives a value from an underlying asset is called as what instrument? Derivative instrument. Respond is or no? Don't talk. Come to a discussion. See. There are so many varieties of derivative instruments. Financial market has become so complex that they invent derivative instruments. They want invent derivative instrument tailor-made for customer, say each and every customer. Okay, but in the market, standardized, if we say, there are 3 important derivative instruments which are there. One is called as options. Second is called as futures. And the third instrument is called as swaps. Okay, options, futures, and swaps are the 3 popular or main derivative instruments one can find in the market. Okay, in which option futures are a different category and swap is a different category. Why? Because options and futures, like shares, currencies, are all traded in stock exchange. They are traded in what? Stock exchange. They have a market. They are traded in what? Stock exchange. So how we can buy and sell TCS share? I can buy and sell what? TCS stock options. Okay, like that. These are all exchange traded derivatives. So they are traded in NSE, BSE, etc. But swaps, unlike options and futures, are not standardized. They are not traded in what? Market or stock exchange. They are made for each and every customer separately by the banks. If a person wants to enter into a swap transaction, the market is what? Banks only, where banks swap for you and the bank swap for some other person need not be what? Same. It depends on negotiation with what? Party to party. Now swap markets have become what? Standardized in banking sector, but still it is not as standardized as what? And options or futures. So we can say options and futures are mainly exchange traded derivatives. What derivatives? Exchange traded derivatives. And swaps are mostly over the counter derivatives. Over the counter means what? Not in exchange, it is between 2 parties privately, because what? Over the counter instruments. Okay, these are the 3 main popular derivative instruments. There are so many other complex instruments also there, but these are the 3 main instruments we're discussing in the classroom discussion. Can I say? So now tell me, what are 3 derivative instruments? Options, futures, and then swaps. Mostly options and futures are exchange traded, and swap is what? Over the counter instrument. Okay, now in which today's class we will be starting with the area called as option. Option is the biggest chapter in what? Derivatives. Once we complete options, the other chapters will move very fast. 2 classes, 3 classes per chapter. But option takes a sufficiently long time, more complex, very interesting concepts are involved. Okay, can we start or not? Now we start with the chapter now called as options. Okay, now give the heading options. Give the heading options. Okay. Instead of shooting in dark, we'll take an example and start discussing it. Okay. Till the chapter gets over, I will not go into market. How it is traded in the market, don't ask me. Don't think about it as a market traded instrument. Simply understand as a contract. Understand as what? Contract. Once this option chapter gets over, I'll give you the live quotes of what? Options. How the option gets traded in the market. At that time, you'll be able to understand each and every number given in what? The stock screen. So they'll be having a better clarity. Till that time, don't go for the practicality. Just understand what? The theoretical aspects. This only makes you understand the stock code in just 5 minutes. Are you follow what I'm saying? So understand this as a independent contract. Don't think as what? A market traded instrument. Understand that much more better towards the end of the chapter. Can I start or not? Now we start with the contract called as what? Option contracts. Can I start or not? Now in that, let us understand the options with the help of an example. With this example, most of the terminologies I'll make you understand it, and some of the calculations also. So the introduction will be fairly long. We have to write some fairly long notes. But once the introduction is over, then we can start doing the problems very easily and quite simply. Nothing great. The chapters are all what? Very, very easy and simple. Only thing is some things may be new to you. That's all. Can I start or not? Now, that's always the first option. Okay? Now, I am going to discuss about an option called as what? Call option. What is an option called as? Call option. Okay? Now, there are two parties, A and B. They enter into a contract. That contract is called as what contract? Option contract. They enter in a contract called as what? Option contract. A gets a right to buy share of X Limited. A gets a right to buy share of X Limited. No need to copy, just listen. Gets a right to buy share of X Limited after 3 months at a price of 100. Okay. Now, this is the detail here. A and B has entered into a contract. Option contract is ditto very similar to forward contract. We saw forward contract in foreign currencies or not? Yes, sir. Forward contract is a contract agreed today or tomorrow. For a transaction to take place tomorrow. That's all. That's all option also. Option and forward are what? Same only. Is a transaction entered today for a transaction to take place tomorrow. At agreed price today itself. Yes or no? No. See. A and B enter into a contract. Enter into what? Contract. A gets what? A gets a right. What is a right A gets? A right to buy the shares of X Limited. Right to buy the shares of a company called as X Limited. This X Limited shares only I call as underlying asset. I call as what asset? Underlying asset. Because the contract is on what shares? X Limited share. So it is going to be called as what asset? Underlying asset. So A gets a right to buy the shares of what? X Limited. Today wa? Tomorrow wa? After how many months? Either we call as the maturity date of the contract or the due date of the contract. Yes or no? So A gets a right to buy the share of X Limited after how many months? 3 months. At what price? 100 rupees. This 100 rupees is what price? Agreed price. No. So A gets a right to buy the share of X Limited after 3 months. And how much rupees? 100 rupees. Can I proceed or not? No. You think and tell me. After 3 months, actually the share is trading in the stock market at 150 rupees. How much rupees? 150 rupees. At the time of maturity of the contract, after 3 months when A is going to buy the share is trading how much rupees? 150 rupees. Tell me he'll buy at 150 rupees, 100 rupees. We are having a right to buy at what? 100 rupees. B cannot say, see share price is 150, give me 150 means what? No. You gave me a right to buy at how much rupees? 100 rupees. A will buy only at 100 rupees. Yes or no? Now, suppose the share after 3 months is trading in the stock market at 80 rupees. How much rupees? 80 rupees. What A will do? He'll buy at 80 rupees, 100 rupees. If it is forward contract, both the parties are bound to buy it. A should buy at what? 100. Whatever may be the share price, buy at what? 100 rupees. This is not a forward, it is what? Option. So A is getting what? Right to buy. He has no obligation to buy. He gets what? A right to buy at what? 100 rupees. If he want, he can buy at what? 100. If he doesn't want, he want to allow the contract to lapse and buy from outside at 80 rupees. Yes or no? That means A can either exercise the contract or what? Allow it to lapse. It is his choice. B cannot compel him. Respond. Yes or no? Suppose the share is trading at 80 rupees after 3 months. What A will do? A will not buy the share from B. He says, I don't want the option to be exercised. I allow the option to what? Lapse. I'll rather buy it from what? Outside market at 80 rupees. Respond yes or no? So the difference between option and forward is option, the contract is binding only on one party. Who is that party? B. It is not binding on what? A. A wants means he can buy at 100. Doesn't want, he need not buy at what? 100. He is having a right to buy. Does not have what? Obligation to buy. But B has to sell at what? 100 rupees. If A wants him to sell it, say buy it at how much rupees? 100 rupees. Everybody able to understand or not? Now, in that case, there are two parties now. Now, first of all, the 100 rupees from now onwards we give the name exercise price or strike price. Because what? Strike price or exercise price is the agreed price. Yes or no? Now, This price can be exercised, also can be what? Last. Who is having the choice? A is having the choice. Am I right or not? Now, next. 3 months we call as what? Term of the option or what? Maturity of the option. Term or maturity of the option. Can I proceed? Now, the two parties na A. A is called as holder of option. Who is A? Holder of option. B is called as what? Writer of option. Now, so tell me, who are the two parties in option? Holder, writer. Holder what? Gets a right. Writer what? Gives the right. Holder what? Gets the right. And writer what? Gives the right. Right or not? Holder gets the right to buy what? Shares of X Limited. What X Limited shares called as what? Underlying asset. At what price? 100. 100 is called as what price? Strike price or exercise price. When? After 3 months. Which you call as what? Term or maturity. After 3 months, should A buy it or not? He may buy it. He may not buy it. This is choice. Nobody can compel A to what? Buy from B because he get only the right. Does not have what? Obligation to buy. Is that different between a forward and option contract? Where forward contract binds both parties. Option binds only what? The writer. Yes or no? So the person getting the option is called as what? Holder. He is holding the option or not? Yes. And second person is called as what? Writer. He is writing the option. Respond yes or no? Can I proceed or not? Now, see. B is insuring A. Simple as insurance. B is what? Insuring A. He insures A against price rise. When the stock price goes up to 200 or 210, he need not own. He has a right to buy at 100. So B is protecting A. He is giving insurance. Now, generally, insurance, there's a policy holder, there's a policy writer. You are taking a life insurance, yeah? So what happens? You are the holder of the policy or not? And the LIC is what? A writer. They protect you financially in case of death. You know what I am saying? In that case, the person who is insuring you is a writer. Person who is getting insured is what? Holder. Same logic here also. Option contract is an insurance. Is what? Insurance against the price changes. Are you following what I am saying? Now, insurance company insures you or not? Free. What they do? They ask you for a premium. They ask you for what? Premium. Like that. B gives A option or not? No. For that option, there should be a price. X Limited share price different. Share is different. But there's an option, no. Option is having a price or not? The price of the option we call as what? Premium. Who pays premium? A. To whom? B. Holder pays premium to what? Writer. As a consideration for the option. As a consideration for what? Option. Now, tell me. There are two prices. Or two prices. Share price, option price. Then they have to demarcate. There's something called a share that is trading. There's also one option. In this option, it will be trading in the stock market. Are you what I'm saying? The premium will be trading in what? Stock market. Okay. There's a share that is what? Option. What is share price? 100 rupees. This is the price of the share option. Share. But I am getting a right to buy the share or not? For that right, there should be value or not? Rights issue is a value for right or not? That's an option. So no, we have a right to subscribe or not. No, there's an option or not like that. There's a right which you are getting. For that right, there should be a value. That value we call as what? Price of the option. They call the price of the option in the market as what? Premium. We call as what? Premium. Who pays premium? Holder. To whom you are writer. Respond up to this. Are you following or not? No. It's the first level introduction to the concept called as option. Please tell me yes or no. We will continue with the same introduction in the next slide. First copy this slide before you go for the next one. First give the heading what? Call option, and then copy this slide fully. Okay. I will go very slowly. If you want to even repeat it, not an issue. Very small, simple issues only, but not to get confused is very important. Okay. Just copy the slide quickly. Finish copying, huh? Finish copying, huh? Those not copy, raising hand. Last one finish copying up. Can I proceed? No. Don't get irritated, just to confirm. A is purchasing how many assets? A is purchasing how many assets? 2 assets. He is purchasing a share, he is purchasing an option. Ennappa, right or not? No. Option is purchased today. Because I am getting the right to buy today itself or not. So option is purchased what? Today. The premium will be paid what? Today itself, upfront. So no, when you take insurance policy, will you pay the premium after you die? Let me die and then pay a premium means not issue. After the policy over, you don't pay premium. You pay premium first and the policy will mature what? Later. So one is A is buying an option. A is buying what? Option by paying what? Premium. Is the first thing which is purchasing. So no. No. Second is A is also having what? Right to buy a share. He is buying an option. He is having also what? Right to buy a share. After what? 3 months. After 3 months he may buy. He may not buy, it is his choice. Everybody, are you following what I am saying? So, for the share, the consideration is what? Strike price. For the option, the consideration is what? Premium. First, try to demarcate both separately. Are you following what I am saying? So, now tell that there are 2 items. What are 2 items here? Share and then option. I purchase option by paying what? Premium. And I have agreed to purchase the share at what price? Yeah, strike price. Strike price is the price for the share and premium is what? The price for the option. Everybody up to this, I have the clarity or not? And A is called as holder, B is called as what? Writer. And the X-limited share is called as what? Underlying asset. And the 3 months is called as term. And the 100 days is called as what? Exercise price. Everybody have the full clarity or not? Now, let me continue with this particular discussion. See. There are 3 types of share prices. How many types of share prices here? 3 types of share prices. Can I proceed? Now, all the 3 words I use very frequently. Okay? Now, one is spot price, another is strike price, and third is future spot price. What are the 3 types of share price here? Spot price, strike price, and future spot price. Okay? Now, I'll explain very simply. Today, in the stock market, this share of X Limited is trading at how much rupees? 75 rupees. What is 75 rupees? Spot price. We don't ask where 75, put the number now only. Can I proceed? Now, today the share is trading in the stock market. How much rupees? Yeah, 75 rupees. It's called as what price? Spot price. That means I can buy the share today by paying how much rupees? 75. If I have a share, I can sell it how much rupees? Yeah, 75. 75 rupees is the today's price of the share. Yes or no? Now, what is 100 rupees? Okay. When I write X in number of books, say in most of them write what? X. X means what? Exercise price. Also called as what price? Yeah, strike price. Okay. What is strike price meaning? What is 100 rupees? It is also price of the share of X Limited only. So no. But it is a price after what? 3 months agreed today. It is a price agreed today. But for a transaction after what? 3 months. Because what price? Yeah, strike price. So 75 rupees is the price of the share today for today's transaction. Is the price of the share today for transaction take place after what? 3 months. Is an agreed price called as strike price. Point number 2. Yes or no? No. Third, After 3 months, at the end of the third month, I go to stock exchange, the share will be actually trading at a price. At the end of third month, should the share be trading at 100 rupees? No. It may trade at what? Some price. It may be 110, it may be what? 90 rupees and so on. The share will be actually trading at a price at the end of third month or not. That price we call as what? Future spot price or maturity price. Are you understanding what I am saying? In a moon price, yeah? What are three prices? Yeah? 75, 100. And future spot price. I gave two situations. The FSP is what? 110 or can even be what? 90. I give you two examples. Are you following what I am saying? Now tell me, what is 75? Today if I want to buy, I can buy it how much rupees? 75. What is 100? The price at which I can buy the share after 3 months. But agreed what? Today. What is, so for example, situation what is 110? The actual share price in the stock market after what? 3 months. What is 90? The actual share price of the share in the stock market after what? 3 months. It can be anything. I took what? Two examples. One it may be 100, another is what? 90. Everybody, yes or no? Now, this future spot price is very important because based on this only, I will decide whether option should be exercised or lapsed. It can be what? Exercised or lapsed. So whether I will implement the option or allow the option to what? Lapse, all depends on what is the share price after 3 months or no. Sorry. The 3 months, after 3 months FSP is going to be the triggering force for me to decide whether the option should be exercised or lapse. Can I proceed or not? Now, next is, always who decides? Holder only decides. Who obeys? Writer. So, we will never speak about writer. Always who decides? Holder. Whether option will be exercise or lapse, it will be decided by what? Holder. When holder exercises it, writer has to what? Obey by it. If he lapse also, he has to accept it. Everybody yes or no? Now. Can I go to the next stage or not? Now. Next. Okay, I will give you time to copy later. Just participate. What are two future spot price? 100 and then what? 90. Please, all of you participate. Okay. Exercise or lapse. Okay. Situation 1. What FSP? 110. What strike price? 100. You are a holder. You are what? Holder. You only should decide or not. I will obey you. Can I proceed? Now you are the holder or not? Tell me. You have a right to buy at what? 100. A share worth. Will you buy it or not? Yes. Will you exercise or lapse? Exercise. Are you all following or not? Now. Suppose the share price crashed to what? 90 after 3 months and the strike price what? 100. So you have a right to buy at what? 100. A share worth what? 90. Exercise or lapse? Lapse. I say rather buy it outside market at what? 90 than buying from the writer at what? 100 rupees. Respond yes or no. So the holder will exercise the call option. If the FSP is what? More than strike price. You will allow the call to lapse and FSP is what? Less than strike price. This should be in your blood. It should be, we'll be asking this question throughout the next 1 month. You know what I'm saying? So when you will exercise, when you lapse here, FSP more than strike price. Think and tell me. FSP more than strike price. Exercise. FSP less than strike price. Lapse. Because strike price is the price at which I can agree to buy. So FSP more means exercise. Less means what? Lapse. Everybody, are you following or not? No. Next. I will discuss the next also. And then, okay, we'll just copy up to them before you go for the put option. Okay. I think I finished copying the first slide or not? No. Right out. Next. Types of prices. Finish copying above. Write down. Types of prices: spot price 75, strike price 100, FSP situation 1 110, situation 2 90. Over or not? Can I see it? Write down. Spot price is a price at which the shares can be purchased or sold today. Spot price is a price at which the share can be purchased or sold today. Spot price is a price at which the shares can be purchased or sold today. Next point. This is point number 1. Point number 2. Strike price is a price agreed today. Strike price is a price agreed today for a transaction to take place. Strike price is a price agreed today for a transaction to take place on maturity date. Strike price is a price agreed today for a transaction to take place on maturity date. In this example is how many months here? 3 months. For a transaction to take place on maturity date. In bracket how many months? 3 months. Can I proceed or not? Next. Point number 2 or 3 here? 3. Future spot price. Future spot price or maturity spot price. Different books uses different names. So future spot price or maturity spot price is a price at which future spot price or maturity spot price is a price at which the share is a price at which the share is actually trading on the maturity date. Future spot price or maturity spot price is a price at which the share is actually trading on the maturity date. Is a price at which the share is actually trading on the maturity date. The share is actually trading on the maturity date. Everybody respond. Yes or no? No. So types of share prices has been written. All these are terminologies which are used frequently, hence getting introduced to it. Can I proceed or not? No. Next. Write down. Exercise or not. Exercise or lapse. Do you understand why to exercise the lapse or not? No. Why situation 1, the holder is exercising it? He is having a right to buy a share at how much rupees? 100 rupees. It is worth how much? Because on that day he can buy it 100, selling outside at 110, make a 10 rupees profit. Yes or no? You get an asset worth 110 at 100. Naturally anybody will be exercising it. Okay? Now. Finish copying, huh? Yes or no? No. So, branch it into 2. Simply branch it into 2. Simply branch it into 2. First branch, right? FSP greater than X. We are generalizing it now, okay? First branch is what? FSP greater than X. So, branch it into 2. First branch is FSP greater than X. X means what? Strike price. Is a future spot price. Second branch is what? FSP less than X. FSP greater than X. FSP less than X. Now, when future spot price is more than the strike price, call option will be exercised or lapsed or exercised. Write down. Call option exercised. Call option exercised. Call option exercised. Now, next case, the call option will be what? Lapsed. Call option will be lapsed. Call option will be lapsed. Okay, just to understand it, when call option lapses, I am a holder, After 3 months, share is only worth how much rupees? 90. I allow it to lapse. Then ask the writer, I gave you premium now, give it back, I did not exercise. Will you give it or not? He is covering my risk. Insurance company is covering I pay premium, yeah? Okay. I said, I am leaving, give me my premium back means what? It is a premium scheme now, it may be, say, it is a health insurance means what? This year I did not get admitted at all. Okay, so give the premium back means what? They won't give it back, right or not? Now, it is a concession for covering the risk, not for what? Exercising or not exercising. Are you following what I am saying? So, this is regarding the call option. Can I continue further? No. We are continuing with the introduction. There exists another option called as what? Put option. Another option called as what? Put option. Please. Give the heading, put option. Let us discuss and then write it. Okay. Now, two parties are there. Party A and then what? B. See, A gets a right to sell shares of X Limited. A gets a right to what? To sell shares of X Limited to B. Okay. After how many months? 3 months. At a price of 100. A is this is called as exercise price, term, holder, and then what? Writer. Everybody following or not? No. See, put option gives its holder a right. Call option also gives a holder a right. Put option gives the holder what? Right. Both the option holder is having a right.
Yes, sir.
A call option holder is having a right to buy. Yes or no?
Yes, sir.
A put option holder is also having a right, but right to what? Sell. Everybody, yes or no? Now, so what is this transaction here? A is having a right to what? Sell. Sell shares of what? X Limited. After how many months? 3 months. Or how much rupees here? 100 rupees. Respond yes or no. After 3 months, suppose the share is trading at 150 rupees. Yeah, how much rupees here? 150 rupees. Answer me. Will A sell to B? A will allow the right to what? Lab and sell the outside market at 150 rupees. Yes or no? Suppose the share is trading at 70 rupees. Will A sell to B or not? Yes. He has a right to sell at what? 100 rupees. He will exercise the right and sell at 100 rupees. Respond yes or no. Now, both options are same. One is a right to buy, another is what? A right to sell. Everybody, are you following what I am saying? This is put option. Right or not? Now tell me, premium is there for the option or not?
Yes.
Who pays premium to who? A pays to B, yeah? B pays to A. Yeah? A pays to B, yeah? B pays to A. Yeah? Because here also, who is purchasing the right? A. A is purchasing the right, for which he has to pay what? Premium. The right purchase may change. One is purchasing right to buy, he is purchasing what? Right to sell. But both are purchasing what? Option only, for the premium has to be paid. Yes or no? Now tell me, A is purchasing or selling? A is purchasing or selling? He is purchasing and then what? Selling. He is purchasing a right. The right is what? To sell a share. Are you following what I am saying? So he is purchasing an option. He is selling what? A share. The option is purchased what? Today by paying what? Premium. The share may be sold after what? 3 months. Situation is favorable to him. Everybody, are you following what I am saying? Either make us what option here? Put option. Please respond yes or no. Now let us discuss. What are the two options? Call option and then what? Put option. Call option gives its holder. Gives its what? Holder. Right to buy. Put option gives its holder right to sell. Call option writer. Listen, call option writer. He is having an obligation to sell. You know, holder is having a right to buy. Writer is having what? Obligation to sell. Put option writer having an obligation to buy. Yes or no? So writer of a call option is having an obligation to sell, and put option writer is having what? An obligation to buy. Point number 2. Yes or no? Now, they have a right to buy or sell at some price. The price is called as what? Exercise price. Of some asset called as what? Underlying asset. After some months called as what? Maturity date. For getting that right, the holder has to pay what? Premium. For giving the right, the writer receives what? Premium under both the options. Everybody have the clarity or not? In a build-up, now, either we call as call option and then what? Put option. Can I say? Now, I'll complete the slides and then give you time to copy. Same way, same pattern as the call option. Okay, now. Then what are 3 types of prices? Spot price, strike price, future spot price. Today if I sell, I can sell how much rupees? 75. I have agreed to sell at 100 today. After how many months? 3 months. After 3 months, the share price can be what? 110 or can be what? 90. Accept or not? Now, let me just go further. Next slide. Exercise on lapse. Okay. Situation 1. FSP 110, strike price what? 100. Who will decide? Writer or holder? Always who decides? Yeah, holder. Okay. In this case, holder is having a right to sell it how much rupees? 100 rupees. A share worth what? 110. Will you sell a 110 what share for 100? No. What you will do? Allow the right to lapse. Yes or no? And you will rather sell it in what? Open market, get 110 rupees. Right or not? Now, next is FSP is 90. Will and the strike price is what? 100. Will the holder exercise or lapse? Yes, because he has the right to sell at what? 100. A share worth only how much? 90. Will exercise the option? Everybody, yes or no? This is put option introduction. Everybody following? Now, simple issues. Can I proceed? Now, copy this before I have an integrated view. Okay? Now, write down put option. Write put option. Sometimes maybe repetitive, but still copy. Okay, write put option. Copy the slide quickly. Finish copying, huh? Those who not copy, raise your hand. Finish copying about the 10. Far left, can I proceed? Now. Shall I put the next slide or not? Next. Yes or no? Copy paste. Call option only. Just please copy paste quickly. For a sense of urgency should be there in copying. Yeah? Copy fast. If a tiger is chasing you, how fast you run? Like that you copy fast. Okay, now. Now, can I proceed? Please, quickly. Please, finish copying, Please, quickly, Have you finished copying or not? No. Otherwise, same as the previous slide, you copy it later. Okay, now. Too long here, this copying time. Copy fast. Font size big, box big, matter small. Okay, now. Please. Shh. Finish copying up. Finished or not? Okay, now, right below that, branch it into two. Please branch it into two. First branch is what? FSP greater than X, FSP less than X. Future spot price greater than strike price. Future spot price what? Less than strike price. All of you. First scenario, put option will be exercised at lamp star. I have a right to sell at strike price. A share will do what? More. FSP. I will be exercising on lamps. Lamps put option. Lamps put option. Now, second case, what I will do? Exercise put option. Lamps put option. Exercise put option. Very, very basic, simple discussion has been made till now. Everybody have the clarity or not? Now, let's write a consolidated definition of these two before I proceed further. Write on first. Write on summary. Write on summary. Point number 1. Call option gives its holder. Summary. Point number 1. Call option gives its holder. Call option gives its holder a right to buy. Call option gives its holder a right to buy an underlying asset. Call option gives its holder a right to buy an underlying asset at an agreed strike price. Call option gives its holder right to buy an underlying asset at an agreed strike price on maturity date. At an agreed strike price on maturity date. On maturity date. Continue. Its writer has the obligation to. The writer has the obligation to. The writer has an obligation to what? Sell. The writer has the obligation to sell if the holder exercises his right. The writer has obligation to sell if the holder exercises his right. If the holder exercises his right. If the holder exercises his right. Everybody, point number 1. Are you following or not? Next, point number 2. Put option gives its holder. Put option gives its holder a right to sell. Put option gives its holder a right to sell an underlying asset. Put option gives its holder a right to sell an underlying asset at an agreed strike price. At an agreed strike price on maturity date. At an agreed strike price on maturity date. An agreed strike price on maturity date. Full stop. The writer of put option has. The writer of put option has obligation to. The writer of put option has obligation to. Tell me, obligation to what? Buy. The writer of put option has obligation to buy if the holder exercises his right. If the holder exercises his right. If the holder exercises his right. Everybody, are you following or not? Last point. Point number 2 or 3? 3. For getting the right, the holder pays the writer. For getting the right, the holder pays the writer. Tell me, the holder pays the writer what? Premium. The holder pays the writer premium. The holder pays the writer premium as consideration. The holder pays the writer premium as consideration. Premium as consideration. Full stop. This premium is popularly called as. This premium is popularly called as option value. This premium is popularly called as option value or option price. This premium is popularly called as option value or option price. Is popularly called as option value or option price. Everybody understood or not? Now, with this we had a small introduction discussion to what? Call option and then what? Put option. Let us continue further. Now, it may seem that I am repeating things. I am reinforcing. Understand that because I am going very slowly, very elaborately the introduction, even though matter is very small, because once you get this very much right, the speed will be very much high in all these areas. We have discussed so many complex concepts later. Everybody, are you following or not? Now, today's class itself, get everything set right, what has been discussed. Can I proceed up? Now, next. Please. Integrated view. Okay, we'll discuss both together for us to understand it. Can I start or not? Now. Rights and obligation. Everybody tell me. Call option. Holder of the call option is having what? Right to buy. Writer. Obligation to sell. Put option holder. Right to sell. Writer. Okay. What is common in holder? Right. What common in writer? Obligation. The right can be to buy or to sell. Since I classify as what? Call and put option and vice versa. Respond yes or no. Now. Next. Exercise price was as FSP. Okay, let's comment it. Now, FSP more than strike price. Who will decide always? Holder. FSP more than strike price. All of you are the jackpot together. But think until call option holder will exercise a lapse. FSP more than strike price. Call option holder exercise a lapse. Why exercise? He has a right to buy at a lower price. A share worth what? Higher price. He'll be what? Exercising the right. Yes or no? Now, put option holder. Suppose a holder put option exercise and lapse. He has a right to sell at what? Strike price lower than the actual price. It's going to be what? Lapse. Now, FSP less than X. This is opposite. Don't think and tell. Okay. Tell me FSP less than X. Call option holder. Last. He has a right to buy at what? A higher strike price. A share what? Lower FSP. What is going to do? Last. A put option holder is going to what? Exercise. FSP is equal to what? Strike price. What they will do? Indifferent. It is going to be exercise or lapse. They will be indifferent between exercising or what? Lapsing. Everybody yes or no? Now, when the option is exercisable, that is, the FSP is favorable to us. Okay, daily we see the FSP what? Increasing. Then we say the option is in the money. The option is what? In the money. That is the premium paid is worth. Now, see, I bought a call option with a strike price of 100. The day I bought it, I bought a Rahu Kalam. So I bought it at a bad time. Yeah. The share price from that day keeps on decreasing. Keeps on what? Decreasing. I'll be very much unhappy because maturity date what is going to be afraid or not. So when the share price is below the strike price, I say the option is what? Out of money. Option is what? Out of money. It's not giving holder any great benefit. Or else what I'm saying? When the say it's going to be what? Exercisable, it becomes what? In the money. And it is indifferent means what going to be what? At the money. Everybody is so no. So when an option is exercisable, it is said to be what? In the money. Option is lapse means what? Out of money. Indifferent means what? At the money. Is the meaning of this. Ennappa right or not? Is the terminology used in the option market. Whether the option is in the money, at the money or what? Out of money. Okay. These terms has got much more interesting connotations when discuss the Greeks later. Are you following what I'm saying? So this is regarding the comment on FSP versus what? Strike price. Fully in the mind or not? All this should be in the blood here. Nobody should think and answer. Instinctively one should be able to what? Answer all these issues. Can I proceed or not? Now, next. Classification, not maturity based. What are the two types of options? There are two types of options, European option and then what? American option. Okay, now, European and then what? American option. Very simple. European option can be exercised only on the maturity date. American option can be exercised anytime during the maturity. Are you understand what I am saying? There are two types of option contracts. One is what? European option contract, and second is what? American option. What is European option? European option can be exercised only on what? Maturity date. Suppose today I buy a call option, strike price of 100. After how many months? Yeah, 3 months. Tomorrow the share price becomes what? 120. Can I exercise that? No. I can exercise that only at the end of what? 3 months. On the maturity date, in only 1 day, I can exercise. It's going to be what? Maturity date. Yes or no? In American option, I need not exercise at the end of 3rd month. I can exercise what? Anytime during the 3 months, whenever I want. Are you understand what I'm saying? Which is more flexible? European or American? Which is having more value? European or American? Above that we'll discuss separately. We'll be having 2 classes for what? American options, and mostly other 6 classes only will be for what? European options. We have a separate discussion about European as well as what? American option later. But both options are same, except that European can be exercised only on what? Maturity date. American option can be exercised anytime during the maturity date. Are the 2 types of options. Everybody yes or no? No. So European option can be exercised only on date of maturity. American option can be exercised anytime before the date of maturity. Can also be exercised on what? The date of maturity. Everybody yes or no? Now, I will give you the notes for this later. Let us complete the slides first. Can I proceed? Next. Sentiment of the holder. Sentiment of the holder. Okay. See. Anybody going into the market can have only 2 sentiments. Bullish, bearish. He can be bullish about the prices or what? Bearish about the prices. Right or not? A bullish person always believes the price is going to what? Increase. A bearish person believes what? Price is going to decrease. If you feel that the market, the price are going to increase in next 1 month, you're saying what? A bullish person feel that no, the share market is going to crash next 1 month. It's going to be what? A bearish person. So it all believes in how you have the sentiment regarding what? The price movement. Yes or no? So bullish person tries to make profit from increasing price, and bearish person tries to make profit from what? Decreasing price. Right or not? So now tell me first, option holder. Okay. Now, call option holder. Tell me, call option holder is a bullish person or bearish person? You are a call option holder. Why you went for call option holder? Because you are afraid of increase in price. Remember? If you know price is going to decrease, you don't go for a call option. So a call option holder fears what? Price rise. He believes price is going to what? Rise. He wants to protect what? Himself. Hence he go for what? Call option. So a call option holder is what? Bullish person. Yes or no? No. Put option holder. Opposite but think and tell. Put option holder is what? Why? Because he is having a right to sell at 100 because he feels that it's going to be wanted 90 or 80 tomorrow. Hence you go for a guaranteed selling price. So no. When I will go for a guaranteed purchase price, when I am afraid of price increase, when I go for a guaranteed selling price, when I am afraid of what? Price decrease. So a call option holder is bullish and a put option holder is what? Bearish. Respond yes or no? Who's that? Now, 2 parties should be there. Who is the other party? Right. Now, writer of a call option is bullish or bearish? Okay. The writer, you are the writer now. You are agreeing to sell at 100. Yeah, writer of a call option is going to buy or sell. You are agreeing to sell at what? 100. Because you believe that the share price will not be 100. It will be what? 90, 80. You allow the option to lapse. I can earn premium. Yes or no? So he believes that the holder is a fool. The share price is going to what? Decrease only. Hence boldly goes and what? Write the option. In that case, he is going to be what person here? Bearish person. And the put option writer is going to be what? A bullish person. Opposite. Everybody yes or no? In the sentiment of a holder and what? Writer. Now, very simple. You are a call option holder. Okay. Now, you are going to pay premium and buy a call option with a strike price. How much is 100 rupees. Immediately, you go to Tirupati. You go to what? Tirupati. To pray to God. What you will pray? God. Share price should increase or decrease. You pay share price to what? Increase. You put 1 rupee extra in Undian also to make a profit. Okay. So you say what? Share price should what? Increase. You pay for increase in share price. Yes or no? Now, I am a writer. I also go to Tirupati. Yes or no? So I put the same 1 rupee. Okay. And I pay the God for share price what? Decrease. So anything may happen to share price. You believe differently. I believe differently. Both of us are praying to God or not? So God will do anything He wants. So He can increase or what? Decrease. Everybody is praying. Right or not? Now, see. In that case, sentiment of both. Please tell me. Call option holder is what? Bullish. Writer is what? Bearish. Then will transaction take place. No. And put option holder is what? Bearish. And writer is what? Bullish. Up to this, everybody following or not? The sentiment of holder and writer. With this, the basic level introduction to the option has been completed. Everybody following or not? No. If stamp race started, okay. No. I'll see how many of you are there at the end. Can I say it? No, it is not. Now, integrated view. Please write down integrated view. Copy the slide quickly as fast as possible. Please. Some things may be repetitive, sometimes may be irritating, but not so. We are reinforcing the basics very much so that you should not think later all these issues. Okay. Now, stop talking. You look at the slide, finish copying. Please write fast. Please. Shh. Have you finished copying or not? Can I proceed further? No, please. So when an option is exercisable, the holder is happy. The premium is what? In the money. In the money means what? Worth paying. Okay. Out of money means what? Premium gone. It is what? Waste. At the money means indifferent. Okay. Either exercise or lapse. Finish copying. Please. Finish copying. Those who not copy, raise your hand. Please, fast. Shh. Now. Shall I proceed? No. Okay. You need not copy this, need not copy this, copy this first, copy this. Sentiments of holder and writer. It's sentiments of holder and writer. Sentiments of holder and writer. Now first two slides only merge to the third one. Yeah, right or not? Now sentiments of holder and writer. So bullish person expects the prices to increase. Bearish person expects the price to decrease. It's all the expectation of the price movements. finish copying? Okay, shall I proceed? Next, write down. Types of options. Types of options based on the maturity base. Types of option based on the maturity base. Branch it into two. Types of option based on maturity base. Branch it into two. Branch it into two. European option, American option. European option, American option. European option, put that down your mark and drive, can be exercised only on date of maturity. Can be exercised only on date of maturity. Can be exercised only on date of maturity. American option can be exercised anytime before. Can be exercised anytime before the date of maturity. Can be exercised anytime before the date of maturity. It can also be exercised on the date of maturity. It can also be exercised on the date of maturity. It can also be exercised on the date of maturity. Can also be exercised on the date of maturity. Simpler can be exercised on or before the date of maturity is the meaning. Can be also exercised on the date of maturity. Everybody, yes or no? No. With this we complete our introduction to this area called as what? Options. Okay. Now, let us take some very simple questions. Take the problem in the workbook. Okay. Okay. We will write the answers in the workbook itself. Okay, no need write in the notebook. Okay, now simple questions. You should understand that. Let us do those problems. Okay, first. So exam write answer in answer sheet. Can I say not in question paper? Can I say bar? From the following, please. Let us quickly do these sums. Question 1, please. From the following, find whether holder of call option would exercise his right on expiry date. Please. Stop talking. All of you should participate. Don't monotonously answer here. Just apply your mind. That's only an exercise problem for you to have a thinking of exercise or labs. Okay. Now, first, situation 1. Call option strike price 190 and on the maturity date, what the price here? 210. That is, I have a right to buy at how much? 190. A share worth 210. Exercise or labs? So write the action as what? Exercise. Action is what? Exercise. Can I proceed or not? Next. Please. I have a right to buy at 200. A share worth what? 190. Will I exercise or labs? Labs. The answer is what? Labs. I have a right to buy at 370. A share worth what? 400. Exercise or labs? It's going to be exercise. I have a right to buy at 400. A share worth what? 450. Exercise or labs? I'm going to what? Exercise. I have a right to buy at 460. A share worth what? 460. Exercise or labs? It is going to be what? Indifferent. I'm going to be what? Indifferent. Generally, please. I may exercise because I buy from outside to pay some brokerage and all, but not so required for what? Buying from the option trader. So it can be exercise or labs. Technically, right what? Exercise or labs. Okay. Exercise or labs. It is exercise. Premium, whether exercise or labs already paid, yeah, sunk cost. Yes or no? You paid premium, then only gives you right. Now, whether you exercise or labs, you want to return the premium back. That is irrelevant for decision making. Yeah, correct. Yes or no? No. Shh. Please. Yeah. Now, stop talking. Can I proceed? Come to the next question, question number 2. And one more question I ask you. Wherever E is put, option is said to be what? In the money. Wherever L is put, is said to be what? Out of the money. And exercise or lapse means what? At the money. Everybody following or not? Now, next. Take question number 2. From the following, find whether holder of put option would exercise a right on expiry date. Now, as a holder of put option, you have a right to buy, right to sell. Right to sell. I have a right to sell at what? 270. A share worth what? 240. Exercise or lapse? I am going to exercise. I have a right to sell at 360. A share worth what? 300. Exercise or lapse? Exercise or lapse? Exercise. I have a right to sell at 450. A share worth what? 400. Exercise or lapse? Exercise. I have a right to sell at 190. A share worth what? 201. Exercise or lapse? Lapse. I have a right to sell at 200. A share worth 205. Exercise or lapse? Lapse. That's the answer for the put option. Yes or no? Wherever exercise comes, the option is said to be in the money. Wherever lapse comes, is said to be out of the money. And exercise or lapse means what? At the money. Everybody, right or not? Now, come to the third question. A little bit interesting problem. Okay, take question number 3, please. What option would you choose? Please. What option would you choose on the following strike price and expected future spot? Will you exercise the option if the actual future spot are as follows? They given you 4 situations. Strike price given, expected future price given, choose the option, actual future spot price, action to be taken. Can I proceed or not? Now, see. Now, let me make you understand the question, then you can start answering it. Okay. Now, there are 3 prices given for the share. One is what? Strike price. Which is what price? Agreed price today for transaction to take place tomorrow. One is expected FSP. Another is what? Actual FSP. Can I say? Suppose maturity period 3 months here. Today I go to an astrologer or Swamiji. I go to what? Swamiji and ask her, so Babaji, what will be the share price after 3 months? He just does some meditation, says what? It will be 120. He says what? 120. And the expected price. Today I predict what? What will be the price after what? 3 months? My expectation, my prediction is or no? Now. And after 3 months, actually a price is going to be there or not? Otherwise, what? Actual future spot price. Ennaya purinjida? Ennaya right or not? Now, again I say, what is the expected spot price? What the Swamiji says will happen after what? 3 months. Okay, prediction is what? The prediction. Yes or no? And what is actual future price? What has happened? From this we can know whether Swamiji is good or bad. Can I put it or not? Now, let's start with the discussion. Now, see. This price is helpful to select an option. The other price will help you decide to exercise or lapse. Are you following what I am saying? Now, can we do it together or not? Now, please, you should answer my question. Okay, now, let us do in same order. Let us be in coordinator way. Let us answer together. Okay, can I proceed or not? Now, see, there is an option trading at 100. And we believe that the share price will be how much? 120. Now tell me, you will be likely to go for a call option with strike price 100, put option strike price 100. Because I believe the share price is going to be what? Higher. I am a bullish person. I am going to be what? Bullish person. I will go for what option? Call option. Based on Swamiji's words, I will go for what option here? Call option. Choose the option, right what? Call. What book can write the answer here? Choose the option, right what? Call option. Okay. Now, after 3 months, what happened? Share price was what? 120. Swamiji good or not? Very happy or not? Yes. Okay. So what you will do? Exercise or lapse? Exercise. Because I have a right to buy at 100. A share worth what? 120 on that day. I'll exercise the option. Response is or no. Since I am bullish, I went for what? Call option. And on that day, actually what I predicted what happened? I exercised the option. Response is or no. No. Next time again I went to Swamiji and said, what will happen to share price? He said, after 3 months, it may be how much base? 160. And now the option is telling how much base? Yeah, 180 strike price. Will you go for a call with 180? Yeah? Put with 180 strike price. Because I expect the price to be what? Decreasing. I'm a bearish person. Yes or no? I go for what? Put holding. So what option is selected here? Put option. Because on the after they believe that how much? 160. So I want to go get a right to sell at what? 180. Yes or no? Now tell me, after 3 months, Swamiji good or bad? He predicted what? Correctly. So what happened? 160. Exercise or lapse? Exercise. The reason is I have a right to sell at 180. The share actually worth what? 160. Should I explain once again? Can I proceed? Okay. Go to the third one. Okay. Now, so I now became a frequent client to the Swamiji. I don't know now. Third case, I again went and asked Swamiji, now tell me what will be the share price. He said, how much is yeah? 120. Okay. Strike price how much? Yeah? 100. He'll right to go for a call with 100. Put with 100. Because I have a right to buy at 100. A share which I expect will become what? 120. I go for what option? Call option. Swamiji right or not? He predicted how much? 120. Become what? 120. Right or wrong? Swamiji wrong only, but wrong on a higher side. Yes or no? So, Swamiji said, I only predicted a minimum increase. God has blessed you very much. It will be what? Very much higher. Okay. So in that case, tell me exercise or lapse? Exercise. Because I have a right to buy at 100. Yes, I have what? 130. Exercise. Everybody, yes or no? Now Swamiji became very great because whatever Swamiji says, you'll have a higher profit. Is what is the brand value. Yes or no? Now, next, fourth case. You went once again to Swamiji. What is the expected price? 120. What is strike price? 135. Will you go for a call or put option? Put option because I believe the price to fall and I can exercise at 135. I went for a put option. I have a right to sell at 135. Yeah, share worth what? 137. Exercise or lapse? Lapse. Baba gone. Can I say not? Now, next. So 140, 170. Please. 140, 175. I have, that is, I'll go for call or put option. Call option. It became what? 135. What happens here? Power and all gone. So we stop going to Swamiji. The problem is over. Yes or no? Now, please. On a serious side, we went for a call option when you are bullish about prices. We went for a put option when you are bearish about prices. Is a moral. Yes or no? And will exercise a call option when the FSB is more than strike price, and exercise a put when FSB is what? Less than strike price. Also has been applied here. Respond yes or no. It is basic in this problem. Question number 3 has been completed. Everybody yes or no. Okay. I think we don't have a time to do question number 4 here. We'll continue in the next class, the chapter options. Okay.